All right, listen closely, because what's happening in silver right now is not a little move, and it's definitely not the kind of price action that politely waits for anyone to catch up. In the last stretch, silver didn't just climb, it launched. And if you blinked, you missed the part where it went from the kind of price most people were still debating straight into a level that forces the entire market to rethink what normal even means. We're talking about silver hovering around $90 an ounce, after ripping higher so fast that even longtime silver believers had to double-check their screens. 2 days. That's all it took for mid-80s to become around 90. And that speed matters, because fast moves change psychology, and psychology changes everything. Now here's the uncomfortable truth. The moment silver starts behaving like this, the average investor does one of two things. They either freeze or they chase. And right here, right at this exact moment, the winners and losers get separated. Because the people who win aren't the ones who scream the loudest on the way up. They're the ones who understand what's driving the move, what could fuel the next leg, and what signs would warn you that a pause, a shakeout, or a fakeout is coming. And before we go any further, I need to say something quickly, and I'll keep it short. My YouTube stats show most of you watching right now still haven't subscribed. If my content helps you, support the channel. Hit subscribe today and drop Our John AG in the comments so I know you're with me. All right, now let's get into it. Because this isn't just silver is up. This is a chain reaction. It's policy, it's geopolitics, it's supply pressure, it's market structure, and it's the mining sector sitting there like it hasn't realized what just happened, yet. And that yet is the part you need to focus on. First, let's talk about the move itself. When silver starts accelerating, it doesn't do it gently. Historically, silver has a reputation for exploding. It spends a long time boring people, then it moves in a way that embarrasses anyone who said it'll never happen. So when you see silver ripping from roughly 50 to around 90, that isn't just a chart pattern, that's a message. The market is repricing the metal, not just trading it. And once the market starts repricing something, it usually isn't finished in a week. That's why you're hearing aggressive targets being thrown around, numbers like 130 or even 140 for next year getting mentioned in the same sentence as silver. Now, can I tell you the exact top? No, nobody can. But I can tell you this. When big targets start appearing after a breakout, it usually means we're leaving the old world and stepping into the wild part of the cycle, the part where volatility becomes the price of admission. And that's why this next section matters a lot. Because the move didn't happen in a vacuum. There's a real-world trigger that deserves attention, and it's not a rumor, it's not a meme, and it's not just speculators. It's supply control. At the start of this year, China put additional export controls around silver, where only state-approved entities can export it. Now pause for a second and think about what that means. Even if silver isn't mined in China, a massive amount of metal flows through refining, processing, and logistics systems tied to China. So when a policy like this hits, it doesn't just slow shipments. It introduces friction into the supply chain. And friction is a fancy way of saying delays, bottlenecks, and fewer ounces showing up where they're needed, when they're needed. And when a market is already tight, adding friction is like throwing gasoline on dry wood. This kind of move also signals something deeper. Governments are waking up to the strategic value of metals. They did it with rare earths, they did it with other critical materials. And now you're watching it reach into precious metals with heavy industrial demand. Because silver isn't just pretty, silver is functional. It's used in electronics, energy systems, industrial applications, things that matter when nations compete. So when export control appears, it's not just an economic decision. It's a geopolitical lever. That brings us to the next layer, geopolitics. We've already seen major turbulence early in 2026, and no matter how you feel about global headlines, markets care about uncertainty. Uncertainty drives hedging. Hedging drives flows. Flows drive price. So the question becomes, how much of this silver move is safe haven demand, and how much is fundamentals? And the honest answer is both. But the bigger engine, the one that tends to run longer than any single crisis, is the one most people ignore because it sounds boring. Debt. Money creation. Currency dilution. If you want one clean way to understand why gold and silver tend to drift upward over long periods, pull up a chart of money supply over decades. It's not a straight line, it's a curve. And that curve tells you what paper currency does over time. It expands. When currency expands faster than real goods, the unit value declines. And metals, especially monetary metals, are like a scoreboard. They don't get expensive. The currency gets weaker. Now add geopolitical stress on top of that foundation, and you're not just adding fuel, you're adding wind to a fire that was already burning. So yes, wars, tensions, and uncertainty matter, But even if the headlines go quiet for a month, the monetary engine doesn't turn off. And that's why this move in silver feels different to many people. It's not just a spike. It's the market admitting that the old price environment was a lie. Now, if that's true, then the next question is obvious. If silver is moving like this, why aren't the miners screaming higher? Because this is where a lot of people get confused. They look at silver running, then they look at a basket of silver mining stocks and they think, wait, why is the metal beating the companies that dig it out of the ground? And that confusion creates opportunity. Because when miners lag the metal during a fast move, it often means the sector hasn't priced in the new reality yet. Miners tend to follow in a sequence. First, the major producers, then the mid-tiers, then developers, then explorers. And the early part of that sequence often shows up when companies report earnings into a higher metal price. Because an extra dollar in metal price doesn't just add a dollar of profit. For producers, it can add a dollar straight to the bottom line with minimal extra cost. Now zoom in on the numbers. If a producer was selling silver around 40 in a previous quarter and prices are now near 90, that's a massive gap. Even if costs rise a bit, the margin expansion can be brutal, in a good way for shareholders. So when those quarterly reports hit and people see the cash generation, the market tends to re-rate the stocks. That's why the next few reporting cycles matter, because you may be watching the setup for the catch-up trade. And the most dangerous thing you can do is assume miners will never respond. They respond, just not on your preferred schedule. Projects that didn't make sense at low prices start making sense fast at higher prices. And that changes what a company can do, what it can finance, and what kind of buyers start calling. That's why I want to talk about a real-world example of how this plays out, without relying on personality worship, without focusing on any single speaker, and without repeating anyone's words. Let's talk about a Mexico-focused silver exploration story. A company operating in the Sierra Madre region has built out a pipeline of multiple deposits, 4 separate discoveries in total. One of those discoveries is newer, high-grade, and already has a resource base measured in tens of millions of ounces. They reported a maiden resource around 54 million ounces, and they're drilling aggressively with the goal of pushing that number closer to 100 million ounces. They've got a large drill campaign underway, 50,000 meters planned, and they're already well into it, with steady results expected throughout the year. Now, I'm telling you that not to sell you on a ticker, but to show you the logic of how silver bull markets pull the entire ecosystem upward. Because when metal prices rebase higher, the market starts rewarding 2 things: scale and grade. A high-grade discovery can work at lower prices, but when prices rise, high-grade projects become magnets. And when a company has multiple deposits, the optionality becomes enormous. Here's the part most people miss. Optionality isn't just nice. Optionality is leverage. At 25 silver, maybe only the flagship deposit is exciting. At 90 silver, suddenly the secondary deposits start looking like they could be real mines. And that's where the story can change. Because the moment a company can start advancing more than one project at a time, you're no longer talking about a single-shot explorer. You're talking about a pipeline. And a pipeline is what bigger players look for when they want to acquire growth without doing the early, messy work themselves. Now, let's zoom into what this drilling work actually looks like. When a company says they're drilling 50,000 meters, they aren't just randomly poking holes. They usually sequence the program. Early meters often focus on stepping out from known mineralization, expanding the edges, deepening the zones, testing continuity. That matters because markets pay for confidence. A resource that grows not just in size, but in consistency becomes easier to model, easier to value, and easier to finance. In a recent set of results from a program like this, the company drilled multiple holes across several veins, including deeper step-outs that tested the system at depth. The key takeaway wasn't just that they hit mineralization, it was that the widths held up, the system stayed open, and the zones didn't pinch out the way skeptics love to assume they will. And in parallel, they also hit encouraging grades and widths in adjacent structures that haven't been drilled as densely yet, areas with lots of room left. That combination, expansion plus new potential, tends to be exactly what you want in an ongoing campaign. Because it creates a story where each batch of results can extend the runway. And runway equals attention. Attention equals liquidity. Liquidity equals valuation. Now, I know what you're thinking. Okay, but what's the end game? Great question. Because every investor eventually needs to know what the company is aiming for. And in a typical path, the goal is to de-risk the asset while keeping options open. That means keep drilling, expand the resource, start baseline environmental work, start the long lead permitting steps, and begin economic studies. Not because they want to build a mine tomorrow, but because those steps add value and make the asset easier for a larger producer to buy. And yes, the preferred outcome in many cases is an acquisition. Because if you already have a producer with operating teams, capital access, and processing expertise, they can often unlock value faster than a junior can. But here's the power move. If you prepare as if you're going to build, you can negotiate as if you don't need to sell, and that shifts leverage to you. Now, before we go deeper, quick reminder. In the description, you'll find bonus links set up for you, including a premium WhatsApp channel link and a channel membership link. Check those out after the video. And speaking of membership, we also offer members-only videos, and these aren't throwaway clips. We have a separate team working on those, doing deeper research and putting extra effort into topics reserved for premium members. Now let's keep going, because the biggest misunderstanding in silver right now is what a new base means. Every major cycle has a reset. Think about the early 2000s into the early 2010s. Silver broke above old ceilings, ran hard, then eventually cooled down and formed a new, higher floor. The old base was a few dollars. Then it became something like 20. Now we're entering a phase where a brand new base may form again, and nobody knows where it will settle. It could pull back, it could consolidate, it could whip violently in both directions. But the act of breaking into a new zone is important because it can permanently change what projects are economic. That's why companies with multiple deposits are suddenly reevaluating assets that looked marginal just a year ago. One deposit, for example, has a resource in the measured and indicated category around 50 million ounces, plus additional inferred ounces, with average grades around a bit over 100 grams per ton in an open pit context. At mid-30s silver, the financial models started looking interesting. At prices far above that, you don't need imagination, you need a calculator. And that's why you could see a project like that move toward a preliminary economic assessment without requiring years of new drilling. Sometimes the data is already there, and the price environment is what changes, so the pipeline can accelerate. And this is where the mining sector can wake up in a hurry, because if a developer can publish economics that look strong at current prices, you suddenly get a wave of attention not just from retail, but from institutions and from strategic buyers. Now, let's switch gears and talk about what could derail this, because every parabolic move creates a trap. The trap is believing that price only goes one direction. But bull markets don't move in straight lines. They move in lunges, then they breathe, then they lunge again. Silver especially loves to punish both sides. It punishes late buyers with sudden drops, and it punishes early sellers with violent recoveries. So if you're watching this and thinking, I missed it, it's too late, you might be wrong. But if you're watching this and thinking, I'm up, it's safe, nothing can stop it, you might also be wrong. The smarter approach is to understand what phase you're in. We are in a breakout phase. Breakout phases can overshoot, but they can also be the start of a multi-year run. And that's why the bigger question isn't what happens tomorrow, it's what kind of cycle are we entering? There's a view that this could resemble the 2002 to 2012 commodity bull market period, not just in silver, but across commodities. And if that's the case, then the silver move you're seeing now may be the opening act, not the finale. Because in those cycles, gold often leads, silver follows later, and then silver tries to catch up by moving faster. That's exactly what a lot of people feel is happening right now. Gold has been strong for a while, silver was late, and now silver is sprinting. If you've been around markets long enough, you've seen this movie. Now, let's go back to China's export controls for a moment, because I want you to catch the nuance. Some people hear export controls, and they assume it means China is running out of silver. Not necessarily. What it can mean is that the state wants more control over where strategic metal goes and under what terms. It can also be a signal to other nations. We have levers. And when nations start using levers, markets start adding risk premiums. And risk premiums show up as higher prices. Even if the actual volume impact isn't massive at first, the psychological impact can be. And when availability becomes uncertain, buyers get nervous. And nervous buyers don't wait for dips, they secure supply. Now, pair that with industrial demand and potential shortages, and you can see why a tight market can go crazy. But again, this doesn't mean it's straight up forever. It means the environment is primed for violent moves. Now, let's talk about the human element, because the silver story isn't just charts and policy. It's also psychology. When a metal sits in a range for years, it trains people to ignore it. Then, when it breaks, it trains people to chase it. That's why the most valuable skill right now is not predicting an exact price. It's staying rational in an irrational market. That's why I want to ask you something, and I genuinely want your answer in the comments. Do you think silver forming a new base happens above 50, above 70, or does it surprise everyone and settle somewhere nobody expects? And second question, do you think miners will catch up in a big way this year, or do you think the metal continues to lead while equities lag? Drop your thoughts below. I read the comments and it helps shape what I cover next. And while you're there, if you're doing well, if you've had a win in metals, mining stocks, or your investing journey, Share your success in the comments. It lifts other people up, and it shows that real progress is possible. Now, I also promised a creative intro for another channel, and here it is, quick and friendly. If you want silver-related success stories, real stories of how people found opportunities and built momentum, there's a link in the description to another channel. Give it a look, and if it helps you, subscribe there too. Now let me add a piece that mainstream coverage rarely explains properly, because it's not exciting enough for headlines, but it's exactly what makes people late to the move. When silver breaks out, the first wave is usually price discovery in the metal itself. That's when futures traders, physical buyers, and macro funds start adjusting positions. The second wave is the equity market slowly realizing that higher metal prices change the math for mining companies. And the third wave, this is the one most people miss, comes when capital markets reopen for the sector. Because in weak silver environments, the junior space can feel like a desert. Financing is expensive, dilution is brutal, and even good projects struggle to get attention. But in a strong silver tape, the doors start opening. Investors stop asking, "Why should I care?" and start asking, "How do I get exposure?" That shift can take a little time, but once it happens, it tends to feed on itself. More attention brings more liquidity. More liquidity brings higher valuations. Higher valuations make financings less painful. Less painful financings allow more drilling and development. More drilling and development creates more news flow. More news flow attracts more attention. And suddenly, you have a feedback loop. That's why I keep using the word repricing. Because repricing isn't a one-day event. It's a process. Now, here's where things get spicy. In the silver mining world, the market often values companies like a story. And stories need catalysts. So let's list out the types of catalysts that can keep a silver narrative hot in 2026, and why they matter for retention, both in a video and in the market. First catalyst, continuing drill results from the flagship discovery. If a company is drilling step-outs and consistently expanding the mineralized envelope, each set of results reinforces the idea that the resource can grow. And resource growth is one of the simplest ways to justify a higher valuation without needing metal prices to go up again. Second catalyst, a resource update. Markets love clean milestones. Moving from a maiden resource around 54 million ounces toward a larger number, say closer to 100 million, creates a before and after moment that people can anchor to. Third catalyst, shifting a secondary deposit from interesting to economic. This can happen when a company initiates a preliminary economic assessment or even just announces they've started work toward one, because that signals confidence that the numbers will tell a positive story at current prices. Fourth catalyst, permitting and baseline work. Fifth catalyst, strategic interest. This doesn't always show up as a public announcement. Sometimes it shows up as unusual volume, tighter spreads, or a slow grind up that doesn't match the general market. And if a bigger player is circling, you'll often see hints before you see headlines. Now, I want you to notice something. None of these catalysts require silver to go from 90 to 140 immediately. They require execution. And execution is what separates a chart that went up from a company that can create value through a cycle. So if you're trying to position yourself, it's not enough to say silver bull market. You need to think, which parts of the food chain benefit first, and which names have the ability to deliver catalysts regardless of daily price swings. Now, let's address the ETF point because it's an important clue. There's a well-known silver miners ETF that many people watch, and lately it has only barely outperformed silver itself, if at all. That's unusual during a sharp metal rally, but unusual doesn't mean wrong. It often means early. During the initial breakout, investors sometimes pile into the metal because it's the cleanest exposure. It's the easiest story. It's the simplest hedge. Stocks, on the other hand, require decisions. Which producer? Which country? Which balance sheet? Which mine life? Which hedges? Which political risk? That complexity can delay the equity wave, but when it flips, it can flip hard. Because once people become convinced the price regime is higher, they stop treating miners as speculation and start treating them as cash machines or takeover targets. And that's when you can get those days where miners run multiples of the metal's move. Now here's another cliffhanger for you. If silver holds a high base for long enough, you may see a wave of mergers and acquisitions that surprises the public. Why? Because producers don't like building new mines from scratch if they can buy de-risked ounces. And juniors, if they've done the work, resource, baseline studies, early economics, can become shopping lists. So while everyone argues about the daily candle, bigger money can be planning 3 years ahead. Now let's talk about Mexico, because it comes up a lot, and it matters. Mexico is historically one of the world's most important silver jurisdictions. It has geology, history, and established mining culture. But like any jurisdiction, it has layers of risk and complexity. Permits, communities, policy shifts. That's why having an experienced local team matters. It's not just about drilling. It's about relationships, logistics, and getting things done without burning bridges. A company that's been operating there for years, with a stable on-the-ground crew, a disciplined approach, and a track record of discoveries, has a different profile than a newcomer trying to learn everything during a bull market. Now I want to underline something else. The 4 deposits concept is not just marketing. If you have 4 deposits, you have options. You can advance the flagship while you study another. You can decide which one deserves capital first. You can sell one, joint venture another, and keep drilling the highest upside zone. And if you're dealing with a producer that's interested, you can offer a pipeline rather than a single asset. In negotiations, that changes the conversation from how much for your one project to how much is your growth platform worth. Now here's a subtle point that can boost your understanding. In mining, the market often assigns different multiples to different stages. Pure exploration can be valued on excitement, but it's fragile. Development with economics can be valued on models and comparables. Production can be valued on cash flow, dividends, and reserve life. A company moving from explorer toward developer can get re-rated even if it hasn't poured a single ounce, because it's stepping into a category that more investors are allowed to own. Some funds can't buy pure explorers. Some institutions need a certain level of de-risking, so the company's stage can change the investor base. Now, if you're still with me, here's the big tension. Silver at 90 makes headlines, but the real wealth transfer often happens in the messy middle. The months of consolidation, the pullbacks that scare people out, the slow-building thesis that rewards patience. That's why I keep warning you. Silver will try to throw you off the ride. It may do it with a sudden $15 dump in a week. It may do it with a fake breakdown that reverses overnight. It may do it with a sideways grind that makes you bored and impatient. And that's exactly when people make mistakes. Now, as we get closer to wrapping up, I'm going to give you a simple summary of what I want you to remember. 1. Silver has entered a new regime. The pace matters. 2. Policy moves like export controls can tighten markets and add risk premium. 3. Geopolitics can amplify safe haven behavior, but the bigger driver is monetary expansion over time. 4. Miners often lag first, then catch up as earnings and cash flow become undeniable. 5. Projects that looked marginal at lower prices can become valuable fast when the base price shifts higher. 6. The best stories in the space are often the ones with pipelines, strong teams, and disciplined execution. And 7. Volatility is not a bug in silver. It's the feature. Now, before you go, one more friendly reminder. Check the description for those bonus links, including the premium WhatsApp channel and the membership option. And if you want deeper research and extra work from our separate team, consider joining for the members-only videos. Finally, if you found value here, do the simple thing that keeps this channel alive. Subscribe. Short, effective, done. And if you're still watching at this point, I want to hear from you. What level do you think silver reaches before it seriously cools off? Drop your answer below, and don't forget, if you support this channel, comment Our John AG. Take care of yourselves, take care of each other, and I'll see you in the next one.